This is the Daily Fiscal Pulse covering the 12th of May, 2026. We're working with Tuesday's finalized data here, so what you're hearing are confirmed numbers, not preliminary estimates. Let's start with what's happening in the broader environment before we dive into the specific flows. The setup doesn't point to one clear story dominating the market. What we're seeing instead is headlines like Kevin Warsh winning Senate confirmation as the next Federal Reserve chair, shaping trader sentiment and feeding into how prices are moving. But headlines are just noise until the flows validate them. That's where the real picture emerges. The net fiscal transfer for the session came in at $14.5 billion, driven primarily by tax receipts which delivered $6.2 billion. At first glance, there's nothing out of the ordinary about that dynamic. The story shifts when you look at the benchmark though. ES futures settled at 7,421, which is sitting comfortably above the 20-day moving average of 7,186. That 20-day range covers roughly 601 points of trading activity. Despite headwinds from the fiscal side, price is managing to hold its ground. Pull back and look at the shorter timeframe and the picture sharpens into focus. Over the last 5 days, government spending is averaging about $2.5 billion per day. Expand that lens to 20 days and you're looking at closer to $8.0 billion daily. That represents more dollars flowing through to households and finding their way into market demand. Widen the view to a full year comparison and the message reinforces itself. Fiscal year-to-date spending stands at $812.5 billion, which runs roughly 29% lower compared to the same window last year. That's a significant pullback in the amount of fiscal liquidity supporting the system. From a trading perspective, the fiscal backdrop isn't tilting the odds in either direction at the moment. The conditions gauge is sitting at +6. That said, context shapes interpretation. We've encountered similar setups repeatedly, and the data shows the S&P has still managed to average around +0.7% over the following month despite softer liquidity conditions. The equity market doesn't move in lockstep with cash flows. It finds ways to advance. One thing worth highlighting on the positioning side, leveraged funds are in a mode of reducing their exposure while margin debt sits at the 100th percentile. That's an elevated reading. Historically, when margin debt reaches these levels, it typically functions as a caution signal rather than a bullish green light. Several scheduled flows on the horizon could alter the current trajectory. The 13th of May brings the Social Security Administration payment cycle, which lands on the second Wednesday and tends to create noticeable short-term flow shifts. The subsequent significant Treasury coupon interest payment window lines up around the 15th of May. Right now the fiscal signals aren't pushing strongly in either direction. The flows scheduled to hit the calendar will be the deciding factor in whether momentum shifts. That's what we're monitoring.